Why is it that millennials are the poorest generation, with baby boomers holding about 50% of all wealth in the United States, Gen X holding about 30%, and the silent generation holding about 12%? Millennials come in at the bottom, holding only 8.5% of all the wealth. And other estimates have millennials having only 6% of all US wealth, after subtracting liabilities. Well, the reason why comes down to a mix of history, economics, and poor decisions. But it is actually not hopeless, as it looks like in the next decade or two, there are going to be some massive things changing that could leave a large percent of the wealth in the hands of millennials and Gen Z. Just to get the ages straight, millennials are the generation of people born between 1981 and 1996, which means currently they're ages 27 through 42. This brings us to the first reason why millennials don't have that much wealth as a percentage, generationally speaking, because of the Great Recession. People aged 27 through 42 right now would put them anywhere from junior high all the way to early start of their career during the Great Recession. Especially for the older millennials who were just entering the workforce at that time, this put a massive step back in their financial plan. Companies were laying people off or hiring fewer, career paths got set back, and one of the biggest things that happened was the housing market, obviously. At that time, millennials were either finishing up their secondary education or just entering the workforce, and the housing market had just crashed, and so they rightly looked around and viewed real estate as a way to almost surely lose money. This meant that for most millennials, they got a very late start in home ownership compared to other generations. When home prices were severely depressed, they either didn't want to or couldn't qualify to buy a home. By the time that situation changed, many millennials looked at the housing market and thought another bubble had already started, and this was 2014, 2015, 2016. Millennials who had bought were at that time selling because they thought, hey, housing prices are up 100 grand from where I bought. This means we're in another bubble and it's gonna come crashing down anytime soon. That has put millennials now in the position where they have been priced out of the housing market because of the situation of low supply, a period of very low rates, and increasing demand from a growing population means that many millennials are currently priced out of home ownership. As home ownership is one of the largest pieces of net worth for most Americans, this is a big setback financially for millennials. But beyond just housing, millennials also got a late start with investing. And as you can see from this graphic, the earlier you get started investing, the more it makes an impact on your long-term returns. Somebody who starts investing at age 25 and invests $5,000 for just 10 years and then stops investing at 34 would have $787,000 by the time they are 65 years old at an 8% return. However, investor number 2, who starts investing at age 35 and invests $5,000 every year until they reach 65, instead of just investing for 10 years like investor number 1. Even though they invest $5,000 every single year, investor number 2 only has $611,000 at age 65 because they got started 10 years later. So this late start can make a very big difference in the total amount of wealth you have long term, which means that the late start that millennials got with starting a family and buying a house and starting investing in their careers are all going to make large differences in the long run. But it wasn't just the great financial crisis that happened in 2009. Fast forward to 2020 and we saw the financial crisis that occurred as a result of all the money printing and now the inflation that's happening afterwards. For millennials at the younger end of the generation who are currently in their late 20s or early 30s, this latest economic crisis is hitting them especially hard at the beginning of their careers. And it's these big drawdowns early on that can have a massive impact on your ability to create wealth long term. And in fact, it's the inability to understand the impact of large drawdowns that causes most investors to lose money over the long run. Consider a fund that has an annual return of 10%. You could achieve this average annual return by year 1 having a negative 20% return, year 2, positive 20% return, year 3, a negative 60% return, and in year 4, having a 100% positive return. If you simply were to look at this and think, okay, I'll add up each year's performance and then divide it by the number of years, then you get an average annual return of 10%. However, the real return for this exact performance is actually negative 23.2%. Because if you start off with $100,000 and go down by 20%, you end that year with $80,000. Then when you increase by 20% the next year, you don't get back up to even, you only get back up to 96,000 because 20% of 80,000 is only 16,000. Every year's subsequent performance starts at last year's ending balance, which means at the end of the 4 years, you'd be left with $76,800. And the difference between the stated average annual return, which is never real in real life, and your real return, which you can calculate with something called compounded annual growth rate, CAGR, is a result of large drawdowns. Things like the Great Recession and the asset bubbles that happen as a result of all the money printing and then those bubbles popping, and now the inflation as a result of that. These are all things contributing to large drawdowns for millennials. And certainly everybody else, but this is happening at the beginning of millennials' careers. This is why a proper risk management system is one of the most important things that I teach members of Heresy Financial University. People go from one trending investment to another, hopping in at the tail end of the trend, and then it starts to go down and they think I'm going to sell once it gets back up to break even, but it keeps going down, and so they sell out of desperation at the bottom right when they've lost their shirt. It's not that people aren't smart enough, and it's not that you can't make money actively investing, or God forbid that you should just throw in the towel and just start passive investing, which is literally gambling today. It's that you don't know how to properly manage your risk, how to stop yourself from ever having those large drawdowns. This is the number one thing that will make or break your ability to make money long-term investing. The next reason why the millennial generation is so poor is because of the college scam. And yes, today, it is a scam. Millennials went through the education system right when college was the most expensive it's ever been. At the same time, going to college actually has the lowest value it's ever had. Millennials were taught growing up by Gen Xers and Boomers who looked around and saw people getting promotions ahead of them or jobs ahead of them that they couldn't get even though they were more qualified just because somebody had a piece of paper from a university. And so millennials were raised being told, go to college, no matter what the degree is, no matter what it costs, no matter how much debt you have to get into, because it will pay off later. Now, this would have been true for Gen Xers and Boomers because the degree inflation hadn't happened yet. It's like if you're in a crowded stadium and you're the only one that stands up so that you can see farther in front of you, that will work. But if everybody stands up, then it's the same as everybody sitting down. And in today's day and age, when literally everybody has a degree, it is no longer a signal of anything. It's just a piece of paper. And that's what a college degree is today, which has left the millennial generation primarily loaded up with a ton of debt and a piece of paper that has no ROI. The next reason why millennials have such a small portion of wealth is because of the current national debt. The older generations that are still alive today grew up with their older generations having not mortgaged the nation's future, which meant that they were able to inherit a lot of the wealth that had been stored up and created. But over the last 100 years or so, that trend has completely changed, and the living generations have continued to borrow more and more from our future to bring that purchasing power into the present. And that burden is now starting to show up with the workforce paying half or more of its income just to pay taxes, and the rest of the burden for that debt is paid through inflation. But at the beginning of the video, I told you this was not a hopeless situation, that in fact the tables may be turning very soon here. One of the reasons why is that on an individual basis, millennials may actually be just as wealthy as prior generations. Now, you may hear that statement and think, what? Because that completely sounds like it's contradicting everything that we've talked about so far. Not so fast. When looking at the wealth distribution per capita by age, we can see this blue line, which represents millennials, is right in line with Boomers and Gen X. While Boomers and Gen X did have more wealth per generation, per age group, that disparity goes away when you break it down per capita. Basically, what that means is that yes, when Boomers were 30 on average, there were a lot of Boomers and they held together a larger percentage of the nation's wealth, whereas millennials at age 30 were a smaller percentage of the population and therefore held a smaller amount of the total nation's wealth. But on an individual basis, per capita, per person, that disparity goes away. This means that if you're a millennial, you don't have to feel stuck and that there are external circumstances forcing you to stay poor. That's not true. Yes, the millennial generation has less wealth, but per person, you actually don't. This is good news, unless you like being a victim. It also means that it's good news for older generations who don't have to feel guilty like they've individually contributed to stealing wealth away from younger generations. And unless you individually have done that yourself, there's no reason to feel any grouped guilt about something like that. That's preposterous. The fact of the matter is that every single generation has had their share of economic crises. We had the Great Depression starting in 1929. We had World War II. We had the near hyperinflation that happened as a result of going off the gold standard in 1971. Every generation has its share of economic hardships. And that has never stopped Americans in the past from producing wealth, and it shouldn't stop us now. You can't control what other people do, forget about it. You can produce your own wealth. Hardships do not prevent wealth creation. In fact, economic hardships are problems. Problems are literally just opportunities. Because if you're the one that goes in there and solves those problems, society will reward you for that. Which brings us to the last point, which is that we are about to face the largest wealth transfer in our nation's history. Millennials and Gen X are expected to inherit $84 trillion by 2045, and a whopping $16 trillion of that could be transferred within just the next decade. Yes, boomers plus the silent generation hold a lot of wealth. But one thing that tends to happen to old people is that eventually they die, and that wealth gets transferred. This wealth will either be inherited or it will be purchased. Here's how. Let's say you are somebody who has no idea how to manage money, you're completely irresponsible, and you inherit a few $1,000,000. Just like winning the lottery, or just like professional athletes, you will go broke because you will spend it all. You don't know how to produce wealth and you don't know how to preserve wealth, you'll lose it all. That money will be redistributed fairly to the producers of wealth that you bought stuff from. On the other hand, let's say you are somebody financially responsible. You have learned how to produce wealth and how to preserve wealth. You inherit that money and you can use it to continue creating more wealth. So inheritance is the first way that this wealth transfer will happen, but there is a second way that this wealth transfer will happen as well, and that is through purchasing. Most small businesses today are owned by people who have no exit strategy. This is why people like Cody Sanchez are teaching people how to buy boring businesses, because the people that own most of the businesses in this country are getting too old to want to continue owning them and running them. Most of them, without an exit plan, will just shut down, which means there's an opportunity for somebody else to come in, like you, and buy that business. And to the extent that nobody does buy these businesses and continue to operate them, that creates new opportunities for new business to take that market share. So while it is true that millennials as a generation are the poorest generation, and while it is true that there have been many economic hardships and many circumstances imposed on millennials that have helped that take place, it is not true that as an individual who happens to be a millennial that you are stuck being poor forever. In fact, individually, you are not any worse off than prior generations. And even if you were, there are people who have had it much worse than you who have done much better. So it's still not an excuse. The largest wealth transfer in history is coming up on us, and it's our job to be prepared so we can take advantage of those opportunities. As always, thanks so much for watching. Have a great day.